Hi everyone, welcome back to Be Rich. Today I want to talk about Peter Lynch's investment philosophy in terms of how can we use it to pick stocks. How can we use his ideas, his framework to help us evaluate stocks in here in India and maybe help us find those multi-baggers which Anand keeps talking about. The reason why I wanted to address this question specifically is because the post videos which I did with Anand and Money Page in Tamil, a lot of you have been asking, even the one which I did about if you had put 10,000 rupees in these companies, what happens? A lot of you had said, yeah, fine and dandy, Vinod. Yes, we can always look back and say, yes, we should have done this, we should have done that. But going forward, how do we find these companies? How should we look at investing and try to get through these multi-baggers? And one of the greatest investors is, of course, Peter Lynch. We have spoken about his books, One Upon Wall Street, Beating the Street. So I thought we'll talk about his ideas of investing, the kind of basic framework he uses for stock picking. He very famously said that you do not need to have, great understanding in terms of mathematics. You don't need to understand bars and charts. If you're willing to invest time reading and researching and understanding the nature of the business which you want to invest into, and if that business makes sense to you, and the simple numbers you're looking at in terms of debt, equity, and cost and earnings, he says doing simple seventh grade arithmetics, you can look at picking these stocks at a great price because market tends to ignore companies for some periods of time and market tends to overbuy companies for a period of time. During these sways, you can definitely move in and make great companies at reasonable prices and hold them for a long period of time and make very handsome returns. This is, in essence, in a nutshell, what Peter Lynch tries to tell you in both these books. If you have not read these books, I highly recommend these books. Instead of wasting time reading anything else or on social media and even watching videos like this, I would suggest you first buy these two books, read both of these books, then you'll have a much better understanding on how to pick these stocks, like how Anand does. It's not a rocket science. It's just about consuming a lot of information and understanding that information in this most simplest nutshell and then making investments based on your understanding. The first thing he talks about is something known as trailing PE and forward PE. The trailing PE, he says, should be less than 25 and the forward PE should be less than 15. So Lynch was known for looking at price to earnings ratio to find reasonably priced stocks. Even Anand talks about this. So I'm telling you, this is not rocket science. He preferred companies which had a PE ratio lower than the industry average to the company's historical average. So you should not look at the Indian market average. You don't look at the sector average. If you were looking into buying Tata Motors, for example, you look at Tata Motors PE ratio historically and you see where is it. And if that specific number is less than 25, which is known as a trailing, or the forward is less than 15, he says this is a good company to look at because the market is not evaluating the price of the share at its optimum level and it's at a bargain right now. So trailing PE less than 25 and the forward PE less than 15 is the first criteria to look at. Now, these calculations for a trailing PE less than 55, you can do it yourself. Forward PE also, you can do it yourself. You can go to Screener, the website, put in the company name you want to look at, and you can start doing this. I'm not going to do an example on this specific video. Maybe on another day, I'll take a company and give you as an example. If you guys would like that, mention it in the comments down below. Then I'll take a company in random, a small cap company or a medium cap company, and I'll walk you through these numbers, how you can get the information on which website, and how you can calculate these numbers and see if it's worthwhile investing. The second criteria he talks about is known as the EPS, which is earnings per share. He says that should have a growth more than 15%. Lynch favored companies with strong and consistent earning growth, though he didn't strictly mandate this. But it is good to have growth because if a company has long growth and it's sustained growth, it's fabulous. That means the company is growing. Earnings are growing, the company is going to grow, the price is going to go up. So it's something to look at. And if the earnings EPS growth is more than 15%, it's fantastic. So there's another factor to consider. The first one is the trailing PE and the forward PE. The second thing to look at is the EPS growth. EPS growth rate should be above 15%. The third thing which he looks at is price to earnings to growth. So price to earnings to growth ratio is the most central thing to his strategy. He's the guy who's made this popular. This PEG ratio, why it's so popular and why everyone talks about it is because of Peter Lynch. If it's less than 1, it's often cited by Lynch and everybody that the stock may be undervalued and there's chances of it growing. The threshold is 1.2. So if you keep it 1.2, that means the stock starts becoming a little bit on the higher side. So if you're looking at the PEG ratio below 1, then the stock is undervalued by the market. So if you want more detailed information on this, again, like I said, go read his books. And then you'll understand why he's saying this. And like I said, if you want to do a detailed example video, primer video, I'll do this. If you guys need me to, let me know. The fourth thing he looks at is known as the debt to equity should be less than 35. He didn't really specify any threshold on this, but this is what you can infer from his book. This book was written for the American market and the American companies. So Anand takes this a step further because he says he changed these to Indian metrics and Indian market and Indian scenario. He says it's better not to have debt at all. So keep that in mind. But there is a trade-off here, which you must keep in mind. A small cap company or a medium cap company requires a bit of debt to grow and become a large cap company. So you cannot have it at zero debt. Though zero debt lowers your risk considerably. But having a company with zero debt also means the growth of that company to grow into a bigger company becomes that much harder because you need debt, you need cash infusion for it to buy new machineries, make new factories, whatever the product it's doing or the service it's doing to grow, to create service wider customers. It needs to grow and it needs capital infusion to do that. And debt is one of the easiest ways to get capital infusion. So I would say you should study and see the debt to equity ratio if the company is able to manage its debt. And if you've seen the company's debt over a long period of time, it'll give you a clear understanding on how it's managing debt. And most of these small cap companies which you should be looking at should definitely be over 20, 30 years old. There are lots of them there. For example, the Cosmo, which we were talking about in one of those previous videos, is a company of that sort. So keep that in mind when you're looking at debt. And the last thing which he didn't have a big stickler or a big rule on was market cap. So if you're looking at small caps, you know the market cap bracket, you should be looking at the medium cap. These rules, if you're looking at small cap, medium cap, I'm asking you to look at using these rules specifically in that market capitalization bracket because these have an opportunity over a period of 10, 20, 30 years to become large cap companies. And if you keep tracking these metrics of your companies, your investments, they have a potential to become a multi-bagger. So buying a large cap company and expecting that to grow 15 or 20 times is much harder because it's already reached a stage. But if you buy a medium or a small cap, there's a huge potential for that company to become 20 times, 25 times. So keep this in mind, okay? And purely I did this video as a learning. I have not recommended any companies. If you notice, I have not mentioned any companies. So the reason is because I want you to do your homework. I want you to read these books. I want you to understand them. Based on your understandings and your risk appetite, you can venture into this. So I hope this kind of gives you an explanation on how 10,000 rupees 30 years ago can become 42 crores today. Thanks for watching the videos, guys, and I will see you in the next one soon. Bye.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.